I'm Josh Murphy, research analyst at Fund Canada, and this is the Investing on the Go podcast. Today, I've been joined by Simon Moon and Alex Game, managers of the Unicorn Smaller Companies Fund. Hi, Simon and Alex. How are you doing?
We're good, thanks. How are you?
Very well, thank you. Well, let's get straight to it then. Smaller companies have had a tough 2022 in terms of share prices and performance. But does this really reflect the underlying earnings and revenues? How have the companies actually fared? Are they able to refinance, etc.?
It has been a really tough 2022 for all things UK and domestic, and smaller companies in particular. I don't think it reflects how these companies have managed operationally. Just speaking to our portfolio specifically, the vast majority of companies have, on an operational level, come in at or above market expectations over the last 12 months. They're all financially resilient. So the refinancing question is not something we've had to face too much within the portfolio. With about half of the portfolio has net cash on the balance sheet. Of those companies that are indebted, the net debt's particularly low when you compare it to the market generally. I think, if I talk to the broader point of the small companies market, I think that's it financially in far better health than it was, say, 10, 15 years ago in the wake of the global financial crisis. I think you're tending to see a bit more of a pragmatic attitude from banks as well, as per what you saw around the COVID period, the first lockdown. You're seeing covenant waivers more frequently and just a bit more of a collaborative approach to financing for companies. But like I say, we've not really seen those sorts of problems within the portfolio. Don't know if Alex has got anything to add.
Yeah, so what we have seen, speaking to Simon's point there, in terms of revenues, earnings still being in line with what we'd expect, we've seen a very significant derating in smaller companies. Smaller companies in general are more domestically oriented than large companies, so more sensitive to sentiment towards the UK economy. Everyone will be familiar with the political backdrop that we faced so far in 2022. Clearly, that hasn't helped. Sterling has depreciated and has been very volatile. All of these things have played into the fact that sentiment towards UK equities and UK small caps in particular have been very depressed over the period. Clearly, that throws up lots of opportunities, though, to buy into very high quality assets at depressed valuations.
Yeah, well, those are very interesting points, and thank you for shedding a light on that. Heading into 2023 and what looks like quite a large recessionary environment, what is your outlook for smaller companies? Can they weather this storm? Do you think some are better placed than others? Once inflation has peaked, will this make a difference?
Yeah, I think the consensus certainly is that we're facing a recessionary environment. I think where the consensus sort of is most variable is how long and deep that recession has been. Obviously, needless to say, we're hoping for a short and shallow one, as are all our investee companies. But I would say that small companies are more likely to be domestically focused. So if we have a domestic recession, they're likely to be impacted. The good thing about investing in smaller companies is that they are nimble, they're more agile, they're able to adapt faster. Again, we saw this through the pandemic, the sort of fleet-footed nature of a small business being able to react faster than a larger comparator. And that should enable them to position themselves well in light of recovery and sort of in light of resilience in a hardening economic condition as well.
Yeah, I think we're likely to see some divergence in performance across different sectors. Clearly, the consumer discretionary sector is likely to face some pressure. You're already starting to see that come through in the earnings performance of some of those companies, and we'd expect that to accelerate going into the early months of next year as we start to see the updates provided by some of these companies. I think, interestingly, there are other parts of the market that may perform better than the market consensus is expecting at the moment. Capital goods is a good example. There are areas within the industrial space in the UK that are still benefiting from the pent-up demand from the disruption during COVID. So there is underlying recovery trends within some of these markets, which I think will will provide an interesting opportunity set for those investors willing to take a slightly longer term view over the next 12 months or so.
On your inflation point, I think that anecdotally from our meetings with management teams, and we, as we've discussed on these podcasts in the past, we put a lot of weight on those management meetings with companies. And our corporate access tends to be very good as well. It does really give us a barometer on various points of interest and the economic health of the economy of the nation. And I would say anecdotally, we are hearing and feeling evidence of inflation peaking, rolling over. That obviously is broadly positive, or universally positive, really. And I think if that has happened, then that does indicate a shorter recession, does indicate a shallower recession as well, and it also indicates that inflation expectations are too high. I'd also say that we've looked at inflation over the last sort of 60 plus years. We've looked at the data of inflationary environments within the UK, and then we've looked at small cap returns post those periods of peak inflation, and there's been three peak periods or periods of peak inflation, very defined periods, and after each of those periods, small companies have tended to outperform over a number of years. So that gives us a fair amount of reassurance that despite smaller companies being a pretty unpleasant place to invest in 2022, the good future might be ahead of us.
And historically, smaller companies have underperformed going into peak inflation, which is exactly what we've seen so far year to date. As inflation has been increasing, smaller companies have come under a lot of pressure. So clearly, people need to take a view on where we are in that inflation curve. We are increasingly confident that we're reaching the top end of that curve, the peak of the inflation curve.
Yeah, well, thank you both for that. I believe you've kind of touched on it there. So, what do you think it will take for smaller companies to do well, once again? What could be the catalyst? I mean, possibly, that inflation peaking and coming down. Do you think that would be the main catalyst to see these smaller companies perform well again?
Yeah, I certainly think that's. That's an element of the catalyst. The catalysts. We've been saying for about 6 years that the UK is cheap and smaller companies are cheap. Ever since the Brexit referendum, it's been very difficult to pin down after this really bad year for smaller UK companies what a catalyst might be. But there's various elements of it. There's the political backdrop, which Alex just touched on earlier. It's been appalling in the UK. And it was putting people off before 2022 anyway. So if you have a decent period of stability on the political backdrop, that will help. Peak inflation sort of being lower and that terminal highest interest rate being lower than market expectations and rolling over, that's probably the strongest catalyst.
Yeah, I think the relative performance of sterling as well. Clearly sterling is depreciated over a number of years now since the Brexit referendum, and this year in particular has been particularly challenging year for sterling. But any reversal in the strength of the dollar in particular relative to sterling, I think would be beneficial for UK equities and also UK small caps in particular.
And finally, sorry, long answer this. Well, there's lots of these factors coming through. M&A activity, the international market, especially, or international companies, especially looking at the UK and seeing cheap companies, low valuations, and that sort of depressed sterling too. It's a double discount. After a busy first half of the year when it came to M&A activity, I think you saw a general reluctance because of that worsening political backdrop you saw in the UK and trustnomics. Now, more recently, you're seeing just a bit more activity in the market. One of our investee holdings in a very concentrated portfolio was bid for 2 weeks ago at a sort of 65+% premium to the prevailing share price. So it is still out there. A flurry of M&A activities couldn't really sort of sharpen people's attention back to allocating towards the UK.
Perfect. While some smaller companies are domestically focused, some are perhaps surprisingly international. What impact, if any, is this move for countries anchoring activities and bringing supply chains close to home having on this area of the market?
Yeah, I think that's a really interesting question. Probably first and foremost, it's important to say that smaller companies in general have shorter supply chains. Clearly that was beneficial during COVID when there was very significant supply chain disruption across the world. That allowed them to manage some of those dynamics a bit better than their larger counterparts. But I think interestingly, we're starting to see evidence that there is this move to reshoring happening. Clearly, domestically, we are an island. Any additional capital spent on those reshoring activities would be positive for our domestic economy and positive for certain areas in particular within the domestic economy. So, greater level of investment in the UK would be beneficial for smaller companies, absolutely.
And you look at sort of the last sort of 20, 30 years in the UK as well, and what we were very open to as a country was globalization. It was a benefit to the populace of the UK. It was something we disproportionately imported de-inflation, basically, and through globalization, through getting it cheaper elsewhere and bringing it in. And what we see this certain sort of increased capital investment within the UK. Not only will it just sort of generally help domestically focused companies, but it should also as well disproportionately benefit the UK, given that there should be more coming back into it.
Perfect. Very interesting. Looking at the portfolio now, I noticed you have a large weight to engineering companies. What do you like about companies in this sector?
Well, it's what we do well in the UK. It's it's part in the UK. We're lucky to have the birthplace of the Industrial Revolution. We're lucky to have an incredibly rich industrial heritage. And that is, these are world-leading companies, absolute market leaders. We're very good at talking ourselves down in the UK. We certainly don't do enough of talking up what we're very good at. And just because of that heritage, we've naturally been left with a lot of these very specialist niche engineers.
Yeah, and I think in many cases, particularly in these smaller niche industrial businesses, they're often seen as very, very cyclical, very sensitive to the broader economic backdrop. We think when you look under the bonnet that there are some really interesting structural drivers in some of these businesses. So a great example is a company called Sellafield, which we invested in for a number of years. This is effectively a fabricator of structural steel, which goes into buildings, offices, data centers, distribution, warehouses, stadiums. So there's some really interesting long-term structural drivers within that business. It's been undervalued for a period, for a significant period of time because the market has seen it as, very, very cyclical and economically sensitive. This is a company that also has a JV in India, so it has some interesting exposure to, a high growth market overseas. The market at the moment, the stock market is placing very little value on that JV. We can see an event at some time in the medium term where Sellafield will try to monetize the value of that joint venture in India, potentially through an IPO, which could be very material in terms of an event to realize value within that business.
And I'm conscious of time, but I will just throw in another example as well. And we've sort of touched on this dynamic when we were talking about the outlook. There's a company we invest in the fund called Castings, which makes components for light trucks, so Scania, Volvo primarily. Over the last 2 years, you've had various sort of supply chain snafus, primarily around semiconductors. That's led to sort of a pent-up demand for these end products. So, I mean, a concern that a lot of people have when they're looking at engineers is that if you are facing a recessionary environment, you'll have this a fall off in demand in unison, which sort of compounds itself and makes a painful recession for those companies especially. However, there's so much pent up demand in the end market for a lot of these companies that that should really help see them through a recession, a more traditionally recessionary period, hopefully unscathed.
Yeah, that's a great example. Castings has about 18 months or so of pent up demand in terms of volumes to just catch up the shortfall during the pandemic, which will clearly dampen any impact of a reduced economic environment.
And kind of on that, what changes have you made to the portfolio in recent months? Any sales or purchases of note?
Yeah, I mean, a period like this year is always awful to go through on a day-to-day basis when you're sort of looking at stock market performance, looking at share price performances. But it does throw up tremendous opportunities. So there is always a silver lining. Our watch list of companies currently probably hasn't been as long as this for many years, or maybe even ever. What we did see was a dynamic over the summer of high quality structural growth companies selling off, and the fund operates a relative value approach. So it's not out and out value, but we'll always try and invest in companies when they're positioned well on the value curve against their historic long-term averages or against competitors in the market. That gave loads of opportunity to add growth companies at good valuations to the company. So likes of Ashtead Technologies, FDM, GB Group, NCC, all growth companies that a year or so ago would have been too expensive for inclusion within the fund, and found themselves at very attractive valuations. And we may have touched on this in the last podcast on Smallcos, but at the beginning of this calendar year, we did take a very serious exercise in reducing consumer exposure. So that sort of trend continued over the year. And I think that if you are going to have a consumer-led recession, I think that places the fund fairly well.
And just expanding on that relative value approach, we are very disciplined in terms of how we apply that relative valuation appraisal to potential new holdings in the fund. Our investable universe, the newest smaller companies index plus AIM, if you look at that index 12 months or so ago, 20% of that index would have been trading at discounts to their long-term averages. We look at it today, just about 70%. So our investable opportunity set has increased materially over the past 12 months as a result of the market moves. And clearly that's allowed us to buy names which historically looked too expensive, the likes of GB Group, NCC, FDM, which Simon listed before.
Well, thank you very much, Simon and Alex. That was both extremely interesting and informative.
You're welcome. Thank you.
If you'd like to find out more about the Unicorn UK Smaller Companies Fund, please visit www.fundcalibre.com. And don't forget to subscribe to our podcast via your usual channel.
Please remember, we've been discussing individual companies to bring investing to life for you. It's not a recommendation to buy or sell. The fund may or may not still hold these companies at the time of listening. Elite ratings are based on Fund Calibre's research methodology and are the opinion of Fund Calibre's research team only.